What if I told you that your government, regardless of which party is in power, has a vested interest in keeping you broke? Not homeless, not starving, not rioting in the streets, but just poor enough that you'll show up to work tomorrow. Here is the uncomfortable truth they'll never say out loud. Modern governments do and function when citizens are financially independent. They need you desperate enough to accept any job, any wage, any condition, because the entire system is built on your labor, your consumption, and your debt. Think about your own life right now. You're working harder than your parents did. You're more educated, more productive, yet you can't afford a house, can't build savings, can't take a risk and start that business, can't quit the job that's destroying your mental health. And every time you ask why, they give you the same answers: the market, supply and demand, economic cycles. What if it's none of those things? What if wage stagnation, inflation, and the cost of living crisis aren't accidents or failures of policy, but the intended outcome of a system designed to keep you employed, taxed, and economically powerless? Before we go deeper, drop a comment. Where are you watching from, and do you feel like you're getting ahead financially, or just treading water? Because this affects all of us, and the unfiltered truth is only told here. Hit subscribe if you're ready to see how the game is actually rigged. Let's go back to 1971, the year they broke the money. August 15th, 1971, President Richard Nixon appeared on television and announced that the United States would no longer convert dollars to gold at $35 per ounce. The Bretton Woods system, the framework that had governed global currency since World War II, was dead. They called it closing the gold window. What they actually did was remove the last constraint on money creation. Before 1971, every dollar in circulation was theoretically backed by gold reserves. Governments couldn't just print unlimited currency. Without facing consequences, gold would flow out of the country, forcing discipline. But after 1971, money became purely fiat, a government promise, and central banks could expand the money supply at will. Now, here's what they don't teach you in economics class. This wasn't a bug. This was the feature. Because when you control the money supply, you control everything. You control wages. You control prices. You control who gets rich and who stays poor. Sound familiar? Since 1971, productivity in the United States has increased by over 250%. That means the average worker produces 2.5 times more value per hour than they did 50 years ago. But wages? Real wages adjusted for inflation have barely moved. For the bottom 90% of earners, wages have been essentially flat since the 1970s. Where did all that productivity go? Corporate profits, asset prices, executive compensation, shareholder returns. But not to you, not to the worker who actually generated the value. Sound familiar? Because this is the exact same pattern we see in every sector. Healthcare costs have exploded not because care got better, but because the system extracts more. Education costs have skyrocketed not because teaching improved, but because student debt became a profit center. Housing prices have tripled relative to income, not because homes got better, but because assets inflate faster than wages. The system is working exactly as designed. You work harder, you produce more, but you never get ahead. And here's the kicker. Governments need it this way. Let me explain. When you're financially comfortable, when you have 6 months of savings, no debt, and assets that generate passive income, you become economically dangerous to the system. You can say no to a bad job. You can strike. You can take time off. You can start competing businesses. You can stop consuming things you don't need. But when you're living paycheck to paycheck, when you're $30,000 in student debt, $15,000 in credit card debt, and $300,000 in mortgage debt, you show up. You comply. You consume. You pay taxes. You're economically captured. Sound familiar? This is the same dynamic as company towns in the 1800s. Coal mining companies would pay workers in company scrip currency that could only be spent at the company store. Workers were technically employed and paid, but they could never accumulate enough real wealth to leave. The modern version is more sophisticated, but the mechanics are identical. You're paid in dollars that lose 3 to 7% of their purchasing power annually. Your raise, if you get one, is 2 to 3%, which means you're getting poorer in real terms. Meanwhile, the cost of housing, healthcare, and education inflates at 6 to 10% per year. You're on a treadmill that's speeding up, and the people controlling the speed know exactly what they're doing. By the 1980s, central banks around the world had adopted a new framework: inflation targeting. The idea was simple: keep inflation around 2% annually to stimulate growth. But here's what that really means. Your money loses half its value every 35 years by design. $1 in 1971 is worth about 15 cents today. That's not a policy failure. That's the policy working. And when your savings lose value, but asset prices inflate, You're forced into debt to access the things your parents could buy with cash. Want a house? Take on 30 years of debt. Want an education? Take on 10 to 20 years of debt. Want a car? Take on 5 to 7 years of debt. Your entire life becomes a debt service obligation. And debt makes you controllable. The government collects taxes on your income. The bank collects interest on your debt. Corporations collect profit on your consumption. And you get just enough to keep going, not enough to get free. This isn't capitalism. This isn't socialism. This is neo-feudalism with better branding. And the people who designed this system aren't in government or corporations. They're in central banks. So who actually architected this system? Most people think it's politicians. But politicians come and go. They're actors reading scripts. The real power sits with central bankers, the unelected technocrats who control money supply, interest rates, and inflation. And the most influential central banker of the modern era? Alan Greenspan. From 1987 to 2006, Greenspan chaired the Federal Reserve. During his tenure, he pioneered a doctrine that would reshape global economics. The wealth effect. Here's how it worked. Greenspan believed that if asset prices, stocks, real estate, bonds went up, people would feel wealthier and spend more. This consumption would drive economic growth, which would justify the rising asset prices. It was a closed loop, a self-fulfilling prophecy. But there was a problem. Wage growth was flat. So how do you get people to spend more when they're not earning more? Debt. Greenspan's Fed slashed interest rates repeatedly, making borrowing cheap. Credit cards became ubiquitous. Home equity lines of credit exploded. Subprime mortgages were invented. People weren't getting richer. They were getting deeper in debt, but their consumption kept the economy humming. And governments loved it. Because when people are in debt, they're compliant. They can't strike. They can't quit. They can't protest. They have bills to pay. Meanwhile, asset owners, the top 10% who own 90% of stocks and real estate, got obscenely wealthy. The S&P 500 went from 240 in 1987 to over 1,400 by 2006. The median household income? Barely moved. This was the birth of the modern wealth gap. And it wasn't accidental. It was engineered through monetary policy. Greenspan knew exactly what he was doing. In his own words, he said the goal was to create a degree of job insecurity to keep wage demands in check. Read that again. The chairman of the Federal Reserve explicitly wanted workers to feel insecure about their jobs so they would not ask for raises. This isn't conspiracy theory. This is documented policy. And it gets darker. Because the model Greenspan built didn't just create inequality, it created systemic fragility. And when it collapsed in 2008, governments doubled down on the same playbook. You won't believe how much worse it's gotten since then. Let us break down the exact mechanics of how governments use monetary policy to keep you poor, but employed, because once you see it, you can't unsee it. Mechanism 1. Inflation targeting. As wealth confiscation, central banks around the world target 2% annual inflation. They frame this as healthy and necessary for growth. But let's do the math. At 2% annual inflation, your purchasing power is cut in half every 36 years. If you're 30 years old today and you retire at 66, the money you save now will lose 50% of its value by retirement, even if you don't spend a penny. But here's the hidden mechanism. Inflation doesn't hit everyone equally. The wealthy hold assets, stocks, real estate, commodities that inflate faster than the currency. Since 2008, the S&P 500 has returned an average of 14% annually. Real estate in major cities has appreciated 8 to 12% annually. But wages? They've grown 2 to 3% annually, barely keeping pace with official inflation, and well behind real cost of living increases. This creates a wealth extraction mechanism. If you earn $50,000 per year and get a 3% raise, you're making $51,500 next year. But if housing, healthcare, and food inflate at 6%, your real purchasing power decreased. Meanwhile, someone who owns $1 million in stocks and real estate sees their wealth grow by $100,000, $140,000 annually without working at all. The system is designed to transfer wealth from labor to capital. And inflation is the silent tax that makes it happen. Mechanism 2. The debt trap and monetary dependency. Here is a stat that should terrify you. Total U.S. household debt is $17.5 trillion as of 2024. That breaks down to $12 trillion in mortgage, $1.6 trillion in student loans, $1.1 trillion in auto loans, $1.03 trillion in credit card debt. The average American household carries $145,000 in debt. And the average interest rate across all debt types is around 5 to 8%. That means the average household pays $7,250 to $11,600. Annually just in interest money that generates zero wealth for them but guaranteed returns for banks. Now here's where it gets sinister. Governments need you in debt. Here's why. 1. Debt makes you compliant. You can't quit your job. You can't strike. You can't take risks. You have payments due. 2. Debt generates tax revenue. You have to earn income to service debt. That income is taxed. The government gets 20 to 30% before you even see it. 3. Debt drives consumption. People in debt keep spending to maintain appearances or cover necessities, which drives GDP growth. 4. Debt prevents wealth accumulation. Every dollar you pay in interest is a dollar you can't invest in assets that appreciate. This is why governments subsidize debt. Mortgage interest is tax deductible. Student loans have government backing. Credit card companies are lightly regulated. They want you borrowing because debt is control. Mechanism 3. Asset price inflation and the lockout effect. Since 2008, central banks have pumped over $25 trillion into the global financial system through quantitative easing, near zero interest rates, and emergency lending facilities. Where did that money go? Not to wages, not to workers. It went into assets. The S&P 500 has tripled since 2009. Real estate prices in major metros have doubled or tripled. Even bonds, traditionally safe, low-return assets, saw massive price appreciation as yields collapsed. But here's the trap. If you don't already own assets, you're locked out. In 1970, the median home price was $23,400, and the median household income was $9,870. The price-to-income ratio was 2.4x. In 2024, the median home price is $420,000, and the median household income is $75,000. The price-to-income ratio is 5.6x. Housing has become twice as unaffordable relative to income. And it's deliberate. When central banks lower interest rates, they make borrowing cheaper, which increases demand for assets, which drives up prices. The people who already own assets get wealthier. The people who don't get priced out. This is called the Cantillon effect, named after 18th century economist Richard Cantillon. He observed that when new money enters the economy, it doesn't distribute evenly. The people closest to the money creation, banks, financial institutions, asset owners, benefit first. By the time the money reaches workers in the form of wages, prices have already inflated. Modern central banking is the Cantillon effect on steroids. The wealthy get cheap loans to buy assets. Workers get wage stagnation and inflated living costs. Mechanism 4. The employment trap and structural coercion. Governments need high employment rates not because they care about your well-being, but because employment is the foundation of tax revenue and social stability. Here are the numbers. Payroll taxes, Social Security, Medicare generate $1.3 trillion annually in the U.S. Income taxes generate $2.2 trillion annually. Consumption taxes, sales tax, VAT, generate another $600 billion. All of this depends on people working and spending. If 10% of the workforce dropped out not to unemployment, but to self-sufficiency or alternative economies, the government would lose $400 billion annually in tax revenue. This is why governments fear financial independence more than unemployment. Unemployment is temporary and manageable with welfare programs, but financial independence is permanent and contagious. If people start opting out of wage labor, the entire system collapses. So governments engineer conditions to make opting out nearly impossible. Licensing requirements create barriers to self-employment. Need a license to braid hair, arrange flowers, or drive a taxi. Zoning laws prevent people from running businesses out of their homes. Building codes make tiny homes, alternative housing, and off-grid living difficult or illegal. Tax structures penalize the self-employed with higher rates and more audits. The message is clear. You can work for a corporation and pay taxes, or you can struggle. Mechanism 5. The 2008 proof of concept. The 2008 financial crisis was the ultimate proof that governments will sacrifice workers to save the system. When the housing bubble collapsed, 10 million Americans lost their homes. The unemployment rate hit 10%. Household wealth dropped by $16 trillion. But the banks? They got bailed out. The Federal Reserve created $4.5 trillion out of thin air and handed it to financial institutions through quantitative easing and emergency lending. The result? Bank stocks recovered fully by 2012. CEO bonuses hit record highs by 2010. Corporate profits reached all-time highs by 2013. But workers? Real wages didn't recover to pre-2008 levels until 2019, 11 years later. Homeownership rates dropped from 69% in 2006 to 63% in 2016. An entire generation, millennials, entered the workforce during the worst job market in 80 years and never caught up. The system was saved. You were sacrificed. And it's happening again. Mechanism 6. The modern escalation, COVID and the Great Acceleration. In 2020, governments printed more money in 18 months than in the previous 200 years combined. The US alone created $5 trillion in new money. The global total was over $20 trillion. And just like 2008, it didn't go to workers, it went to assets. The stock market hit all-time highs during a pandemic. Billionaire wealth increased by $2.1 trillion in 2020 alone. Housing prices surged 30 to 40% in 2 years, pricing out an entire generation. Meanwhile, workers got $1,200 checks and were told to be grateful. Inflation is now running at 3 to 8% depending on how you measure it. Rent is up 30% since 2020. Groceries are up 25%. Gas is up 40%. The wages? Up 5% if you're lucky. You're getting poorer in real terms. And it's by design. Because governments can't afford for you to be wealthy. Wealthy people don't need government programs. Wealthy people don't take jobs they hate. Wealthy people don't comply. The system needs you desperate. So where does this leave us? The modern economic system has been fine-tuned over 50 years to create a permanent class of productive poor people who work full-time, pay taxes, service debt, and consume, but never accumulate enough wealth to opt out. You're not a citizen, you're a revenue unit. And the next crisis will make this even worse. Central banks are already talking about central bank digital currencies, CBDCs, programmable money that governments can track, tax, and control in real time. Imagine a world where your money expires if you don't spend it, where the government can see every transaction, where your ability to buy or sell is tied to social credit scores or compliance metrics. That's not science fiction. That's being tested in China right now. And it's coming to the West. The final stage of this system isn't a collapse, it's total control. You'll still be employed. You'll still consume. But every aspect of your economic life will be monitored, manipulated, and managed by algorithms you can't see and policies you didn't vote for. Here is the brutal truth. Governments don't want you unemployed and desperate, but they also don't want you wealthy and free. The sweet spot is poor but employed, struggling but compliant, working but never winning. And unless you see the game for what it is, you'll play it until you die. The lesson here isn't despair, it's awareness. You can't opt out completely, but you can build skills, assets, and relationships outside the system. You can minimize debt. You can stop trading your finite time for infinite inflation. And you can stop pretending the system is designed to help you succeed. So I'll leave you with this. Are we wiser now, or are we just better dressed serfs in a digital plantation? Drop your thoughts below. Subscribe if this woke you up. Share this with anyone still pretending hard work alone will set them free. The truth doesn't negotiate.